Okay, so let's unpack this. It's Monday, January 26, 2026.
hmm
And if you're listening, I'm going to bet you spent the morning, refreshing that app,
Oh, yeah. There's no sugarcoating it. It is a heavy morning.
staring at a number that starts with an 80 and just feeling that specific tightness in your chest.
Exactly. Bitcoin's trading between 87 and 88,000.
Yeah.
And look, if we were having this conversation 5 years ago, that would sound like a lottery win.
Of course. But we don't live in a vacuum.
We really don't.
No, we live in the shadow of October. And that's the context we have to start with, because to understand the panic today, you have to remember the absolute euphoria of October 6, 2025.
Which feels like a lifetime ago, doesn't it?
It really does.
But, I mean, it was literally just last quarter. That was the day it hit the all-time high of $126,279.
The six-figure era. I remember it so vividly. And it was confirmed by everyone. Reuters, Bloomberg, CoinMarketCap.
Yeah, it was everywhere.
It felt like, the arrival. And now here we are looking at a drop of roughly 30 to 35% from that peak.
Which is completely shifts the narrative, right? The conversation flips from how high does the rocket go to is the engine broken?
Exactly. And that's our mission for this deep dive. Is the engine broken? We're digging into a breakdown from a source called OscarAI, analyzing work from Oscar Hernando. He calls it an antidote to panic.
And it's a fitting title. I mean, what I like about this analysis is it doesn't just say, don't worry. It lays out five, specific evidence-based reasons why this was probably inevitable.
Right, and why the whole thing is actually structurally fine.
Exactly.
He starts with a metaphor that I think just nails the current mood perfectly. The hangover.
It is the perfect analogy for market psychology. October was the party. You had the memes, the group chats going crazy, just the pure intoxication of hitting 126K.
But you can't have a party that intense without, a cost the next morning.
The biological cost.
Yeah.
And we are deep in the headache phase.
We're chugging water, wondering why we did that. But here's the crucial distinction the source makes, and I love this. A hangover is painful, but it's not a terminal illness.
Right, and that's vital. The source argues the drop wasn't a fundamental flaw. Bitcoin didn't break.
The code didn't fail.
No. The headache was caused by leverage.
Let's dig into that a little, because leverage liquidation is a phrase you hear a lot, but the scale here was just massive. The report says over $20 billion wiped out in a single day.
$20 billion. And just to clarify, this is the mechanical clearing of borrowed money. When traders get greedy, and they got very greedy in October, they borrow funds to bet on the price going up.
They're betting with money they don't actually have.
Exactly. And when the price dips, even a little, the exchange just automatically sells their position. There's no negotiation. It's an algorithmic flush.
Which pushes the price down more, which triggers the next person's automatic sale, and on and on.
It's a cascade, a long squeeze. The source emphasizes this is a healthy, if incredibly painful, flushing of the system. It moves coins from gamblers to long-term holders.
It resets the whole table.
Yeah. And if we zoom out like the source suggests, this whole crash looks significantly less terrifying.
It's all about perspective.
Totally relative. A 35% drop hurts, no doubt. But the source pulls up the historical drawdown data, and it's a real reality check. Bitcoin has seen drops of 70 to 90% 5 separate times.
5 times? Wow.
I mean, 2011 was a 93% crash. Imagine that. You put in $1, you've got 7 cents left. 2013 was 83%. The big crypto winter of 2017-18.
94%? I remember that one.
And even in 2022, we saw a 77% fall.
So compared to that, 35% is mild.
Historically, it's scratch. It's a flesh wound. And the point isn't just, it could be worse. It's that in every single one of those cases, the asset recovered. It came back stronger.
It's a pattern of resilience. It gets knocked down, the media writes the obituary, and then it gets back up.
Which brings us to the first major pillar of the argument. We had to reframe how we see volatility.
Okay, this is where it gets academic, which I like. Because we're all conditioned to see volatility as risk. If a stock is jumping 10% a day, something's wrong.
Precisely. In stocks, stability is the goal. But the source argues that for Bitcoin, volatility is a feature, not a bug. It's part of the DNA, and there's hard data on this.
The source cites some research from Yale, right?
Yes, a study in the Journal of Portfolio Management from 2021, and also work by Tsavinsky at the NBER. These are heavy hitters.
And what did they find about these huge swings?
They found that these post-peak corrections, yet the exact phase we're in right now.
This is us?
This is us. They are, statistically, accumulation opportunities. The data showed that buying during these phases has historically offered average returns of over 300% in the next 2 to 3 years.
300%. So that's the risk premium. You get paid for having a strong stomach.
Exactly. You can't have the upside of Bitcoin with the stability of a treasury bond. But there's another layer to this. The market is actually slowly calming down.
Calming down. It really doesn't feel like it.
It's a slow trend, but it's there. Back in 2011, annual volatility was over 100%. In this cycle, it's hovering around 60%.
That makes sense. As the market cap gets bigger, it just takes more capital to move the needle.
Exactly. It's the difference between a splash in a bathtub versus the ocean. The Wild West days are slowly fading.
Which is a perfect segue into reason number 2. Who is actually holding right now? Because if retail investors are panic selling, someone has to be buying.
The smart money. And this is the institutional adoption argument.
So are the big suits selling off?
No. The source is clear on this. Despite the price drop, the major play, we're talking MicroStrategy, BlackRock, Fidelity, they're in a net accumulation phase.
I think people get confused by headlines about outflows. We did see some selling in late 2025.
We did. But the source clarifies that was mostly tactical rebalancing. The core positions are still there. These places operate on 5, 10-year horizons. They have committees.
They're not panic selling on a bad Monday morning. And the breadth of this adoption is wider than I thought. The source quotes the Cambridge Center for Alternative Finance.
It's a staggering number. That report says about 60% of global institutions now have some exposure to crypto.
60%.
5 years ago, that was single digits. It was a career risk to even mention Bitcoin. Now it's a risk not to have an opinion.
And that provides a kind of floor for the market, doesn't it?
It does. There's a paper cited from the Journal of Financial Stability that argues this integration reduces the risk of a permanent collapse.
Right.
The asset becomes almost too entrenched to fail.
They provide a backstop. Speaking of math, let's go to reason number 3. This is the one that always feels like magic, but it's purely mechanical. The halving cycles.
It really is like clockwork. I mean, it's so rare in economics to have a supply schedule that is totally unchangeable.
Right. If gold gets expensive, you just mine more gold.
Exactly. But with Bitcoin, the supply schedule just doesn't care what the price is.
So the source directly connects the run-up to 126K in 2025 to the supply shock from the 2024 halving. That was the fuel.
Correct. The halving cuts new supply in half. If demand stays flat or grows, the price has to go up. It played out just like the models predicted.
But is this correction phase also part of that cycle? Or did it break this time?
No, this is standard operating procedure. Post-halving peaks are always followed by these digestion phases. Miners adjust, leverage gets flushed. It's the market exhaling.
And the source has some eye-watering stats on what happens after these cycles finish.
The historical multipliers are just wild. After the 2012 halving, we saw 9,000% growth. After 2016, 2,000%. Now, obviously, those percentages shrink over time.
Diminishing returns?
Right, but the direction is still the same, up and to the right eventually. The source even brings up the stock-to-flow model, which still basically holds scarcity drives value.
So the economic engine is fine. But what about the technical engine? Reason 4. Network fundamentals. Is the network itself broken?
That's the critical question. And the answer from OscarAI is a definitive no. The network is probably the strongest it's ever been.
What metrics show that?
The hash rate. That's the total computing power securing everything. It's at record highs, over 500 exahash per second.
500 exahashes. That number is so big, it's just an abstraction.
Think of it like a wall of digital energy. It makes the network virtually impossible to attack. It's an impenetrable fortress of math.
And usage is up too.
Yep. The report cites blockchain.com data showing daily transactions are regularly over 300,000. So despite the price panic, the network is just chugging along, processing value.
So price is volatile, but the infrastructure is solid.
Exactly. And the source makes a great point about utility. In the West, we see Bitcoin as a number on a screen.
A way to get rich.
But it cites studies on places like Argentina or Venezuela, where it's not a stock pick, it's a life raft. When your currency is collapsing, Bitcoin, even with a 30% drop, is a better store of value.
That's a great reality check. It's easy to forget that global context.
Yeah.
Okay, final reason. Reason number 5. This is the one to use on a skeptical relative. The comparisons to traditional assets.
This is where we bust the myth that Bitcoin is uniquely risky. We have such short memories about the stock market.
So what are the examples the source uses?
First, gold.
Mm.
The ultimate safe haven, right? Well, in 2008, gold dropped 45%.
45%. People forget that. I feel like that gets erased from the history books.
When people need cash, they sell everything, even gold.
And what about stocks?
This is the best one, Amazon. Today, it's a utility, runs the internet.
Huh.
But during the dot-com collapse, Amazon lost 95% of its value.
95%.
Can you imagine buying at 100 and watching it go to 5? People would have called it a scam. They'd have said the internet was a fad.
And most people would have sold at the bottom.
Exactly. The point is, paradigm-shifting tech is always volatile. The source says this volatility is the price of entry for future growth.
But you don't want it to just be another tech stock that moves like Apple. You need diversification.
And it doesn't move in lockstep. This is key. IMF data cited in the source puts Bitcoin's correlation with the S&P 500 at around 0.4.
So not zero, but low.
It's low enough to matter.
Huh.
A big meta-analysis in 2023 confirmed that adding a little Bitcoin to a traditional portfolio actually improves your risk-adjusted returns. It's a real diversifier.
Okay, let's try to wrap this all up. The HODL case. We're down, we have a massive hangover, but the institutions are buying, the hash rate is at a record, the halving math is on track, and history says this is an opportunity, not a funeral.
And speaking of funerals, I have to mention my favorite stat from the report, the obituary count.
Oh, this one is great.
The source notes that as of today, the media has declared Bitcoin dead 463 times.
463 deaths. It's a very resilient corpse.
It died at $1. It died when Mt. Gox collapsed. It died in 2018. And yet here we are talking about an $87,000 asset.
It persists. Now, before we sign off, the source had some interactive challenges for the listener. I like these because they force you to look at your own psychology.
They're great exercises.
Yeah.
The first one is a self-audit. Go back to October 2025. Look at your texts, your trades. How did you feel? Were you euphoric?
It's a lesson in identifying the top. When you feel like a genius, it's time to be careful. And when you feel sick, like today, that might be the time to pay attention.
Exactly. The second challenge is a reading assignment. The Derberg 2016 paper on Bitcoin as digital gold.
We'll link that. Why that paper?
It's just a classic. It grounds you in the data, in the actual financial properties that make it unique, beyond all the hype.
And the third one?
A simulation. This is the fun one. Just run a portfolio simulation with 10% Bitcoin from, say, 2015 to now. Don't look at the weeks, look at the decade.
So a standard portfolio, and you just sprinkle in 10% Bitcoin.
Yep. And see what that does to your overall curve.
I have a feeling it changes the picture quite a bit.
Seeing that long-term slope is often the best cure for short-term panic.
Cures the myopia.
Exactly.
Now, obviously, we have to say this is an analysis of the source material. We are not financial advisors.
Please do not mortgage your house. We're just connecting the dots from the research. But the picture those dots form is of a market that is maturing, not dying.
So if you're staring at that chart today, take a breath, zoom out, remember the hangover, the party happened, the headache is here, but the underlying health is fine.
Ignore the noise. Wait for the comeback.
Thanks for diving in with us. We'll catch you on the next one.
Stay curious.